From an ESOP perspective, how does that help promote sustainability, right? The long-term future of the company for either the rank and file employees or those key levels of management, right? Executives and the leadership team. And there's really a couple of key aspects that are associated with ESOPs that promote that as opposed to other succession strategies, right? First and foremost is that in most ESOPs, we create a pool of SARs, or stock appreciation rights. These are synthetic equity units. We can dive into more detail on what those truly mean in our executive comp session, but effectively what they are is we're able to allocate synthetic equity to key people. They're designed to promote the value of the company, right? Designed to promote the growth of the enterprise value. If I grow by $1 million of value and I have 10% SARs, that's $100,000 that gets paid out to me, right? It creates that incentive to promote the type of behavior that you want from your key executive team, right? Which effectively increase revenue, reduce expenses, generate more profit and shareholder value. The other aspect of it is the ESOP really creates a tax-free environment if it's structured the right way. So in an S-Corp owned ESOP, we're able to mitigate income taxes for the earnings of the corporation. And as a result, we have more free cash flow to reinvest, to pay off debt, to generate more value for the shareholders, buy more equipment, hire better people, expand the company geographically, whatever that might be. And so obviously being in a tax-free environment allows for better sustainability over the long term than being in a taxable environment. The other aspect is the share allocation piece. And so in an ESOP buys all of the shares. It then allocates the shares over time to the employees based on the plan document. That might be based on compensation, might be based on years of service, maybe some sort of combination of both to be able to allocate those shares each and every year. But that allocation process doesn't all happen in 1 year, right? We haven't paid off all of our debt in 1 year. Plus, we don't want to allocate all the shares over 1 year, because then how would we allocate it the next year? And so that share allocation is designed to be a long-term allocation for those employees to incentivize them to continue to grow the company, continue to add value, be more productive, and all of those types of great behaviors that you want out of your employee base. And so when we combine all of those, right, the tax savings, the SAR allocation or the executive compensation component, and then the share allocation for the employees, we're able to create that long-term sustainability. I think one other aspect that has nothing to do with the financial ramifications of an ESOP is just being able to say that you're employee-owned. People love that, right? We see it in the marketplace all the time, see it on logos, see it on trucks, see it on billboards, right? Websites. People are proud of that. And so the idea of becoming employee-owned or being an employee-owned business, you typically then can attract better people and retain better people as well. They see the future, they see the value that's in it for them over the long term, and they're able to really understand what it means to be an owner, an employee owner, and they want to continue to do a great job year after year.